Yeah, welcome to this webinar this morning. Very much focused on the retail investment community, and I'm delighted to be able to give you the opportunity to present Mpac's results for the full year and the progress we're making on our strategic goals. But first of all, may I introduce you to Adam? Adam joined Mpac last November as the COO, and following an extensive onboarding period, I'm delighted that the board has decided to make Adam the new CEO, starting from the AGM later this year in May. And I'm very confident the business will continue in very good hands. Adam's already demonstrated that he understands the Mpac business model, the market situation, and where the key driving points are to go forward. So Adam, can I just pass over to you to introduce yourself briefly, please?
Yeah, thank you, Tony. So hello everyone, I'm Adam Holland. I started my journey in life as a Cambridge physicist, and left university to join a satellite power systems business. I actually was involved in putting the first lithium-ion batteries onto any spacecraft application anywhere in the world or above the world. And I've moved on and spent the last 25 years running various different businesses. Initially with Rolls-Royce, and then Siemens, and then just before joining Mpac in November, I was with JCB. So most of my experience was with large PLCs, but also JCB, obviously a privately owned business. The common thread through all of that for me was that each of those businesses were engineering technology-based businesses. They were a nice mix of product and service, and they were all global. So when I joined the Mpac team in November, I felt kind of instantly at home. So it was a business I understand how we operate. But what for me was really exciting was the opportunity. I've worked in businesses that were often a lot smaller than Mpac, some that have been 6-7 times bigger than Mpac, and I've run businesses at every scale in between. Some of them have been turnarounds, some of them have been growth opportunities. Mpac is absolutely all about growth. We'll talk today about the size of the market opportunity ahead of us, and for me that was a really exciting thing joining the team. I'm obviously delighted with the board's decision to appoint me as CEO, and I'm looking forward to meeting more of you in the months and years ahead. Thanks, Tony.
Thanks, Adam. Yeah, just to say from myself personally, it's been a great journey over the last coming up 7 years, and I'd like to thank all the investors for their support. I'm really looking forward to starting a new chapter of my life, exploring new opportunities, which probably don't involve too much long-haul travel and endless nights in hotels, I have to say. I absolutely believe Adam is the right person to take Mpac forward. We've worked together for 5 months, and he really does get the business and where the opportunities lie. So I think we'll be in very good hands going forward. So for today's presentation, I'll start off with a brief summary of the progress we've made. I'll then pass you across to Adam so he can explain the business model and where the USPs are. He'll then pass you across to Will to go through the financial highlights. I'll come back and make a brief summary at the end, and then we'll have time for Q&A. So without further ado, I'll crack on. I'm pleased to report that Mpac achieved a strong recovery in H2 due to the prior planning, completing numerous projects that were held up due to the shortage that we reported previously of key electronic components. Overall, the group managed to navigate a challenging operating environment and is well positioned to get back on track for our strategic journey. I'd say we are back on track. The medium-term prospects for the group continue, and I'm very excited that Mpac is well positioned to deliver on that growth. Just to remind maybe the newer investors to what does Mpac do? Mpac provides automation and packaging machinery equipment used by the FMCG industry to assemble and package their products for onward distribution, storage, and finally consumption by the public. The equipment we supply maximizes packaging quality and process efficiency and works sustainably to minimize waste. So we provide the equipment for the FMCG companies to pack their products for onward distribution to everybody, including us as end users. So the overview for the year, we don't have it on here per se, but the order book is a key KPI for us. And the order book, if you read the note, you'll see that it's actually lower than it was the year before. But that doesn't give you the perspective. At the end of 2021, there was a surge of order intake as our customers realised that lead times were getting elongated. So we had a surge of orders, which meant that then you can see the order intake differences there. But normally, if we start the year with 50% order coverage of OE projects, so equipment projects, that's a good position to be in. And we're in the mid-60s starting 2023, so that is a really good position to be in. And when you add the recurring service orders that we've managed to build up over several years, that is an excellent position. So we're really confident about our 2023 forecast. The revenue grew marginally, but the most interesting part of that is the service continues to grow year on year. And as you all realise, the service revenue brings a much better margin and also brings us closer to our customers. And I think that's the thing that people don't sort of draw the comparison to. You know, yes, it's great to have growing service revenue, but it just brings the customers closer. So that continues. Clearly, the overall profit was down, which is was a concern for us, but that's definitely a H1, H2 issue. We saw the supply chain challenges coming. We worked hard with cost reductions, really focused on the supply chain, focused on engineering to look for alternatives, and put a meticulous plan together for the second half of 2022, which we then executed. So you can see that the situation changed in the second half. Working capital expanded, and I know that's going to be a key topic. That was necessary to mitigate the challenges we faced. This is now unwinding and will continue to do so during 2023. A key point in the year was that we delivered just recently the battery automation line, so-called CQP, to FREYR in Norway. So strategically, Mpac made really good progress in the year and continued our strategic journey, including innovation. We had the inaugural year of our Mpac Academy, which we'll talk about a little bit later as well, which I'm really pleased to have initiated and see the first year through. And I'll now pass you across to Adam to take you through more details of the year's progress and what we actually do in more detail as Mpac. Thank you, Adam.
Thank you. Okay, for the next few minutes, I'm going to talk a bit about what we do in Mpac, the markets that we operate in. I'm going to describe a bit of the progress that we've made in 2022, some of the things that we're focused on in 2023, and then we're going to run through 2 or 3 case studies just to kind of bring that to life. But I think this chart is perfect to start with, because at the bottom of your page, you can see some cartoons that explain exactly what it is that we do. You know, Tony described it at the outset. We build the machines that our customers use to assemble and package their products. And if we go from left to right, you can see us assembling machines and then packaging our machines, packaging the primary packaging for those systems. That could be things like putting tissues into tissue boxes. Then we move on into our secondary packaging machines. So that could be, for example, putting beer cans into a 6-pack or a 12-pack of beer. And then finally, we've got the end of line processes. So that could be putting all of those cartons into corrugated cases, cardboard cases, or a tray, and then onto pallets for onward distribution. You know, what we do depends on a really, really close relationship and a really deep understanding of our customers, the way our customers assemble their products and the way their facilities then process those for packaging and distribution. In the middle of your screen, you can see 3 of our product ranges: the Lambert, the Langen, and the Switchback product ranges. And we'll start with the Lambert on the left-hand side. The Lambert product range specializes in automated assembly. Okay, it's got a particular focus on medical and healthcare. So that could be things like contact lens manufacturing, ostomy, wound care, and so on. Then in the middle on the right-hand side of your screens, you can see the Langen range and the Switchback range. So these are focused on secondary and end-of-line packaging, particularly in food and beverage and healthcare. That could be applications like putting frozen pizzas into pizza boxes, ice cream bars, right the way through to medical devices and personal care items. And across the whole of that range, you know, we really operate as one Mpac. You know, the whole line philosophy here, we might see a Langen cartoner, for example, feeding into a Switchback case packer. And across the whole of that, our whole life approach, we operate the Mpac Cube. That's our service offering. and that really spans the whole life of the product. And of course, sustainability and whole planet is a growing theme across the world, and we're going to talk much more about that in the slides that follow. Next chart, please. So today at Mpac, we operate from 4 manufacturing sites here in the UK, in the Netherlands, in the US, and in Canada. We've got 8 customer service hubs across the world, and that global presence is really important. As we go into the case studies, you'll see just why. We've got more than 180 global engineers and designers working alongside supply chain professionals, project managers, field service technicians, and a whole host of other support functions. And we support an installed base of more than 4,000 machines in service today worldwide. Now, in the top right-hand corner of your screen, you can see a pie chart describing the sectors that we operate in. Food and beverage makes up just about a half of our business today, and healthcare makes up a further third. And in 2022, clean energy grew to being just over 10% of our revenue in the group in 2022. Next chart, please. Now, the way our business model works, the way we approach our customers, is in 5 phases. And the first of those is consultation. You know, we work very closely with our customers during their design phase, when they're designing their product, designing their packaging, designing the way that their assembly facility and their production is going to work. And that's very much for us the way into our customers. And it leads to the core of our business, which is design and build and installation. And in those phases, you know, we are designing, building and installing the machines that our customers will use to automate their assembly and production packaging processes. And then finally, we move on into monitor and optimize. We're increasingly using digital technologies to monitor machines, performance, and to optimize our customers' production facility. You know, it very much speaks to the kind of industry 4.0 trend across the world. And you know, whilst for us the digital piece of service is a small piece of our revenue today, you know, it's incredibly important for that kind of stickiness that keeps customers coming back, you know, time and time again. Next chart, please. Now, I said at the outset that for me the opportunity was very exciting, the market opportunity that Mpac faces, and you know, you can see on your chart in front of you the markets that we're in are huge. The data on your screen comes from PMMI and from other industry reports, and it gives you some idea of the market and the market share that we have today. Now, not only are our markets very large, but they are growing, and they've done so consistently year on year for many years now. You can see the compound annual growth rates in the right-hand side of the chart. The things that have driven growth in those sectors, the sectors we operate in, are pretty fundamental. You know, rising populations, we've got urbanization, growth in GDP per capita. All of these things are contributing to an increased need for packaged food and beverage. And then if you add on to that increased life expectancy and rising standards of living around the world, you know, those trends are driving the medical and healthcare sectors as well. And then overarching all of that, we've got a growing focus on recycling, reduction in single-use plastics. You know, those are strong trends that Mpac is very well placed to support. And the growth in demand for batteries, you know, that's a strong driver of the clean energy sector that you know, Tony mentioned at the outset is now a growing importance for us. And we've seen this year, 2022 just gone, how robust those markets are. You know, we've been in the midst of an affordability crisis. We've seen the Russian invasion of Ukraine and the disruption that that's caused to markets around the world. Now, for us, in our markets, there has been a change. The change has been towards more affordable food and beverage, for example, but no overall reduction in the demand for new projects going forwards. So that's very encouraging. Now, all of that aside, you know, the compound growth rate is exciting, but it's the market share opportunity that I think is probably most important to take away from this chart. You know, although we're a decent sized business already at £100 million turnover, you can see in front of you the market opportunity that still lies ahead of us. And we choose to operate in these markets because of the potential for long-term growth. Next chart, please. There's quite a lot going on this chart, and I'm just going to use it to pick out a few highlights from the strategy. And you know, in particular, I'm going to focus on people, on customers, on service, and on delivery. So at the very top of your chart, the first row talks about going for growth. And new customer relationships are for us very important. You know, that was a strong theme of the work that Tony and Will and the team led through 2022. One of the case studies that we're going to discuss in a couple of minutes, we'll talk to exactly that. And it's increasingly important as we go into 2023 and the years ahead. If I jump to the very bottom of your chart, the 5th row on your screen talks about people. And the second of our case studies is going to be all about our people. You know, we're a project services and engineering business. That's what we do. It's engineering projects and services. And that fundamentally depends on the people in our business. So our focus in that area has been important in 2022, and it's increasingly important in the years ahead. A service as a business, you know, Tony talks about the growing trend in our revenue for services. We're focused on driving our business to 30% of our revenue coming from services in the years ahead. We're not quite there yet, but we've made some absolutely superb progress over the last 6 years under Tony's leadership, and we're going to continue to do that. In 22, just last year, we launched the Americas Healthcare Service Team, and that was in response to a demand from customers in the US, in the healthcare sector, for increased service support. We've put that team in place. It's been really, really well received by our customers. And of course, it's led to growing revenues in that part of our business. But more importantly for us, it's led to an opportunity for a further healthcare sales in the years ahead. So, you know, that works really well. We're going to continue to do that as we go into 2023 and future years. I think lastly, it's impossible to talk about strategy without touching on operational efficiency and delivery. So in the middle of your chart, you can see that there, you know, obviously we had an interruption in our supply chains last year. It led to a surprise for us during the year. And the response that Tony led with the business drove a really strong recovery in the second half of last year. The things that we've done to address those issues in the semiconductor supply chain and the chip shortages that affect so many industries worldwide, you know, those issues haven't gone away. It's the way that we've built responses to those issues to deal with the issues ahead that's important. That involves us redesigning our products around alternative parts that could be available elsewhere. Our suppliers doing the same to redesign their products away from particular semiconductor shortages to take advantage of improving levels elsewhere. And of course, we've also put in place a significant stocking policy. So we're now increasingly buying ahead of projects in order to make sure that we've got the components we need before we take those orders. So those activities and many more have really improved the way that the business is positioned to deal with those challenges in the years ahead. Next chart, please. So I'm going to talk you through 3 case studies. This is the first with Tattooed Chef. Now, Tattooed Chef are a leading plant-based food company. They offer ready-to-cook meals and organic smoothie bowls. And the team at Tattooed Chef, when they set out to put this their facilities together, were looking for a really automated approach to food production in the way that they prepare their food, but also in the way that they package and end-of-line their product. And they were trying to do that within a really tight footprint within their factories and all at really quite high speeds of production. So the team at Mpac worked with Tattooed Chef during that consultation phase, developing a turnkey solution. It was the first time Tattooed Chef had done some of these things. So, you know, the ability for Mpac to design, build, install, and then support through the whole of the life cycle of the product was very attractive to our customer. And I think for me, it shows the innovation and the collaboration that Mpac teams bring to work every day. Those are 2 of our core values within the Mpac business. Part of the reason that Tattooed Chef selected us for this program was whole line, whole life, whole planet. You know, and you can see in the bottom of your chart a whole line put together by the Mpac team. Whole life, obviously, we talked about installation, commissioning and support, and then whole planet is absolutely core to the message that Tattooed Chef are all about. So we're really pleased to work with Tattooed Chef on those programs. Next chart, please. So you've got a fantastic picture there of Tony with a broad smile on his face, shaking hands with Tom. I was in the room that day. This was the graduation of the Mpac Academy graduates 2022. It was a program that Tony launched last year, and we brought into our first year of the Mpac Academy aspiring leaders from across the Mpac world. And they ran through a program of workshops training modules, group project work. I joined the business at the very end of the program and was privileged to be with them for their graduation on the day that that photograph was taken. This week, we've launched the Mpac Academy 2023 with a new cohort of Mpac Academy members. Class of 23 are now supported by the class of 2022. The graduates from last year are now the coaches and mentors for this year's intake. And this program is absolutely central to how we build the talent base across the Mpac team. Next chart, please. Okay, this is my final case study for you today, and this is an example from a healthcare application. It's an innovative medical device that's been launched by one of our customers just in the last few weeks to improve diabetes management around the world. So you might have seen those kind of diabetes patches that link directly to your mobile phone, giving you live data. These kinds of applications, they require really, really careful data control to verify that the right device with the right instructions is put into the right carton and all labeled properly and done at very, very high speeds. So that, you know, the machine vision systems, the robotic handling that we've designed for this particular customer had to be highly integrated with the customer's information management system. And all of that requires very close collaboration. I think it's absolutely fantastic to be on a program like this. It's a product that will make a huge difference to many, many people across the world. And it's that global footprint that's important. This particular customer operates from manufacturing facilities in the US and in Asia and was looking for a supplier like Mpac and selected Mpac because we could offer that global support to offer the same level of service, the same installation, the same standard of machine in the US and in Asia. Next chart, please. So I've talked several times today about sustainability. And so perhaps it's appropriate that my final topic today wraps up with sustainability too. I think it's impossible to work in any industry today without talking about reduction in packaging materials, elimination of single-use plastics, improvement in efficiency, and in particular energy efficiency, and the drive to net zero. And at Mpac, we're really proud to collaborate with our customers on those topics. They are challenging topics for our customers to address. And solving challenging problems is one of the things that Mpac does best. Will.
Okay, thank you, Adam. Hannah, could you go to the next one, please, as well? So I'll run through the financial review, the highlights for the year. Well, there's already been expressed clearly. The challenging first half to the year with supply chain disruption, especially impacting project efficiencies and project margins. I think pleasingly, however, the mitigation measures that were implemented around the turn of the half year, as expected, they improved trading performance in the second half of the year. But to go through the main KPIs on the screen in front of you, so start with order intake. So order intake was 83.8 million. It's 29% down on the prior year of 117.9 million. For those who followed Mpac for some time, you might recall that we shared with you at the beginning of last year that we saw a bow wave of orders coming in from customers at the end of 2021. This was on the back of customers trying to secure delivery dates as supply chains extended. So the comparator somewhat inflated there due to the basis of orders being brought forward by customers. To give a little bit of colour of the split between service and original equipment. So service was really strong order intake, up 21% to 26.6 million. So strong year for our service business. OE order intake, because of that acceleration of orders to the prior year, was down 40% to 57.3 million. And regionally, it was the Americas that we saw customers making that step to accelerate order intake. So it was the Americas that we see lower order intake in the year. EMEA was broadly unchanged with the prior year. Moving on to revenue, 97.7 million, up nearly 4%. Perhaps easier to look at the bar charts at the bottom of the page there to get some more colour or flavour. So OE revenue broadly unchanged, 74.6 million. But it's service revenue, you can see there that a significant step up again to 23.1 million in the year, And it also demonstrates quite nicely that the trend over the 5 years there, where we've put all the focus on developing the service business, and you can see the development on revenue over that time horizon. There's a little bit more detail of revenue on the next slide, but so I'll skip past that now. But that combination of order intake and revenue, plus obviously the open order book, it leaves us with a closing order book of 67.2 million, which gives us good coverage over forecast revenue for 2023. And then moving on to gross profit and profitability. So gross profit for the full year was 25%, down from 30.6%. But again, it's probably worth reflecting on the bar chart below, which shows the half-year trend of gross profit margins. And clearly, first half, as we've spoken about, significantly impacted by project execution margin. Those mitigation measures, which we spoke about during 2022, they included identifying and sourcing alternative sources of supply of electronic components, really close vendor management and supply chain management, and utilization of the data within our ERP system to plan meticulously on component requirements. They helped to shore up gross margin in the second half of the year, and there was a significant receipt of control systems around the end of Q3, beginning of Q4, which allowed us to start to clear the backlog of projects in that time horizon, and that's flushed through to a much better trading performance in the second half of the year. So margins in the second half of 29%, yeah, they broadly take us back to where we've been in prior years, and that trend has continued into the first quarter of 2023. That lower margin dropped through to underlying operating profit of 3.9 million, and after underlying interest on borrowings, underlying PBT was 3.5 million in the year, which calculates through to an underlying EPS of 13.3p. We can move on the slide, please, Hannah. So there's a little bit more detail here on the income statement. I'll pull out a couple of points that haven't already been spoken about. You can see the split of revenue development and percentage growth there. So service up to above 14%. Strong development in it's generating the returns from the investment in that in developing the service part of the business is one of our main strategic growth initiatives. In terms of gross profit, we've already talked about some of the drivers there to the low gross profit. We're going down to selling, marketing, and distribution costs. Distribution and shipping costs have been higher. We've experienced in pound sums about 500,000 of extra shipping and distribution costs in 2022. In addition, there was a flagship packaging machinery trade show in the Americas in 2022. They don't happen every year, it's every 2 or 3 years. There wasn't such an exhibition in 2021. And so those two factors explain some of the transition from the 6.8 million to the 8.1 million from 21 to 22. Administration costs are lower. We kicked off a variety of series of cost out measures in the second half of last year to help shield the operating profit from the disruption from the supply chain, and some of that savings is coming through in lower administrative costs in the year. The only other item I'll pull out here is non-underlying items, which you can see is 3.3 million compared to 0.4 in the prior year, so that's a significant transition. So in the prior year, we had 2.4 million of release of credit in respect of deferred consideration on the 2019 acquisition of Lambert. Taking that out, they're broadly unchanged. And within non-underlying items, it's the amortization of acquired intangibles and pension admin charges making up the bulk of the cost in that position. We can move forward on the slide, Steve Hannah. So to run through the balance sheet, again, I'll pull out the larger items. The UK pension asset, surplus of 31.5 on an accounting basis. Probably more important is the technical provision basis. So the actuarial deficit We have concluded on the June 21 valuation. We signed off on that with the trustees in December 2022. That took the actuarial deficit down from 35 to 28 million. It reconfirmed broadly an unchanged recovery period. It takes us out to December 2025. But it captured in that several other benefits for the company within the schedule of contributions. What it really confirms is that the scheme remains on the same glide path to get to a fully funded position. And once funding levels improve, obviously it gives us the opportunity to talk meaningfully with the trustees about a further or full de-risking and decoupling of the pension scheme, which remains the company's longer term strategy. I suspect it will take that full recovery period before we can realistically reach anything like that type of goal. But the good news from this triannual valuation was that we remain on track. Looking at inventory, so yeah, they are higher. That was a conscious decision that we made during 2022, both to bulk buy the critical control systems that we needed to clear projects that were in the order book, but also to give us coverage against forecast orders for 2023, so that we are doing all we can to mitigate against a similar impact from supply chain disruption as we had in prior years. So that increase in inventories, yeah, it's a conscious decision. It's higher than it's been historically. We feel that we've taken every reasonable step to mitigate the impact of further supply chain disruption, and the excess stock that we have to cover 2023 requirements. It takes us through certainly across the majority of the year, and we look at it constantly to see how lead times are, and as lead times reduce, we can start to taper back. But for the moment, that's a level of inventory which we're broadly happy that we need to carry. And the other significant increase in the year was in respect of trade and other receivables. So this is broadly split. The increase is broadly split between trade debtors and contract assets. So this is a factor of having more individual projects live during the second half of the year, pending receipt of these critical control systems, which arrived late Q3, early Q4. As they arrive, we can kick on those projects and get them completed. They still take some time to complete them. Over the course of Q4, a reasonable chunk of those were completed with factory acceptance testing, getting to billing milestones, which converted the contract asset to trade debtors. Not early enough for a significant amount of that trade debtor balance to be converted to cash. And then in addition, there was still a bow wave of projects pending reaching that billing milestone. So on the positive side, we see the project status moving forward with the receipt of those control systems to a further stage of completion, getting closer to key billing milestones or tripping into trade debtors. In reality, funding that increase was required from a drawdown against our RCF. So you can see we drew down 8 million in the second half of last year. Since the turn of the year, as you would expect, those trade debtors have converted to cash. Those contract assets have started to convert to trade debtors and partially to cash. So we're now, as at today, in the position where we're back to a net cash position as that build up of contract assets and trade debtors unwinds, and we expect that unwind to continue over 2023. We're guiding through to something in the regions of 6 to 8 million of net cash by the end of the year, and so far in Q1 it's on track to reach that threshold. And if you go back for 10 years prior to 2022, Mpac had operated with a broadly balanced level of working capital. Fundamentally, the project with FREYR aside, nothing has really changed within our structure of how we contract with our customers. So again, clean energy projects aside, which I think we need to look at in a slightly different light, there's no reason why we shouldn't be able to trade and unwind this level of working capital and get back to a more balanced position by the end of the year. Yeah, probably next slide, please, Hannah. So here, the cash bridge, it pretty much gives the visual overlay of what I've just spoken about there. We started the year with 14.5 million of cash. There was an EBITDA number impacted by first half margins and profitability. Working on a larger portfolio of projects which were incomplete by the end of the year, all within trade debtors, has increased working capital. That was funded with a drawdown of the 8 million. We have some commitments to our pension schemes, 2.1 million cash commitments in the year, and CapEx was 2.4 million. That left us with 4.2 million as a closing gross cash. As I say, on a net basis, as at today, we're now back to a positive net cash position. So in all, I think you can summarise it to say we feel there was a strong rebound in the second half of the year. Margins in the second half improved. We've seen that those margins have been relatively consistent into the first quarter of this year as well. Gives us confidence for 2023 overall. We've got a good level of coverage over our revenue from the opening order book, and order intake in the first quarter has been in line with expectations. The peak in working capital was at the end of the year. That was perhaps somewhat unfortunate, but there's been a strong rebound in the first quarter, which we expect to continue. So we've started the year on track, and we're confident in our forecasts to the market for the rest of the year. So with that, I'll pass back to Tony.
Thank you. Well, I'll be very brief because I know there'll be a few, well, there are already some questions coming in. So, just to remind ourselves that Mpac's end markets are large, they're growing, and they're resilient. We've seen that over the last few years. The One Mpac strategy is really delivering benefits. You can see that with the service revenue, not least, the innovation, the new product pipeline that we continually sort of fill and deliver new products to the marketplace, the people strategy. The order book, the prospects are robust, as Will's just explained, and we've got a good start to the year, so we're confident with the forecast, and we can be because of the actions that we put in place last year on the supply chain side of things. And it's not just, supply chain, it's engineering, it's making sure that we have alternatives and making sure that we on a planning side of the business, we're on the front foot, which we've done and we've put in place. The CQP line, the focus this year is on the battery qualification. We don't really have a slide about CQP and FREYR, but if there are questions, and Adam can fully answer those. But that qualification of the battery is the stage gate to open up further market opportunities once people can see the machine actually working. So, lastly from me is to thank you all for your continued support, and to reiterate that I really do believe Mpac is in great hands with Adam joining the business, getting his feet under the table now, and really starting to form his views on where the business can go in the future. So back to you, Hannah, for some Q&A.
Regarding the battery plants. The battery plants using the 24M technology, is Mpac better placed than competitors to win contracts?
So Adam, do you want to take that one?
Yeah, happy to. I think Tony talked about the work we've done to get to a point where the CQP line has now been delivered to Norway. Next week, FREYR will open that facility on the 28th of March, and that then starts a several-month-long activity to commission that facility, up to the point where in July, FREYR are intending to demonstrate a battery production, in-spec batteries being produced at that CQP line in the middle of this year. All of that done with Mpac equipment, fundamentally manufacturing the cell to 24M's IP. That is a fantastic achievement for us to go for this year, and we are 100% focused on doing that, supporting FREYR, supporting 24M, and the other partners, of course, who put in place the other machines across the FREYR plant. To get to that point, getting to that milestone will absolutely position Mpac for the future, for clean energy and for batteries. So I think the answer is yes, it puts us in a very good place. But our focus right now has got to be on that immediate activity of closing out the actions to commission and get to a in-spec battery in the middle of this year.
Okay, thank you. Couple of questions for you, Tony. Why are you departing at this juncture? It's such a pity to see you going after the fantastic progress.
That's very kind of you to say. Yeah, well, you know, these things have a natural process, don't they? As a board, we obviously look at succession planning very carefully. And we started a process a couple of years ago talking about who would be the next CEO. We went out then to a reputable headhunter and started to have those conversations. And that timeline was a couple of years ahead, and it's amazing how time changes so quickly. For me personally, it's all about, you know, you make yourself some promises in your life that you want to do other things, you want to explore other opportunities. So I don't see it as retirement as such, but I do see it as a move away from the sort of full-on CEO executive role into more support and advisory roles. So you know, it's just the natural period I feel in my life where I need to move into that position. But we have gone through a very rigorous process, and as I've said a couple of times, I really do believe that Adam's the right person to lead the business in that next phase.
Thank you. Well, Adam, there's one here for you. Will Adam, as CEO designate, continue the stated policy of actively pursuing acquisition targets, or will the focus be on normalising the balance sheet first?
It's a funny either-or question, because the answer is probably both. Listen, I've had 5 months now in the business to reflect and really think deeply about the strategy that Tony put together 6 years ago. You know, we talked a bit about that as we went through the presentation. Service as a business, going for growth, and so on. My take on the strategy that Tony put together is it's about right. You know, it's doing the right kinds of things. And I think, you know, if Tony was staying on as chief exec, I'm sure he'd say the same things as I'm about to say. You know, my challenge is to do it better and faster in the years ahead. And that strategy was always a mixture of organic growth and acquisition. And you know, I certainly see acquisition as part of our strategy for the years ahead. However, yeah, I think whoever asked the question is absolutely spot on. You know, the build-up of working capital and the consumption of cash last year meant that was our priority in the second half of last year. Will talked about the fact we've got to net cash so far in the first quarter of this year, which is tremendous progress, but we've got work still ahead of us to unwind the rest of our working capital, or make significant progress in that through the rest of this year. So, you know, I think the answer is yes, acquisition will continue to be a part of our strategy going forwards. And yes, our immediate priority is on normalising the balance sheet first.
Well, you've obviously read the other questions up there, Adam, and I think, Will, you rather covered this off in the presentation, but perhaps worth reiterating the plan for unwinding that working capital position over the rest of the year.
Or the winding capital. I'm working the winding capital, Will.
Yeah, easy for you to say. So, as you would expect, this has been an absolute focus of management of the business to ensure we optimise the unwind of working capital. We're going to close quarter one in a much improved position. It's your net cash balance, something in the regions of 1 to 2 million net cash. Okay, it's nothing like the position we've been in the past, but it's a lot of progress made in just 3 months. There is fully expect that progress will continue during quarter two, and we will close the half year still with a net cash position, and we feel comfortable with the guidance we put out in the closing balance sheet for 2023 of 6 to 8 million of cash for the full year. So I think there's a clear trajectory you can see based on that feedback of where we are on that journey, and how that will progress through the half year to the full year.
Thank you. Let me dot over to the subject of supply chain issues now, and perhaps reiterate some of the points you are making in terms of what you've seen from them easing, and what measures you've put in place to resolve these issues.
I'll start the answer, and then I will pass you across to Adam, because he's really been focused on this the last couple of months. Just to reiterate to people, the issue is silicon chips. When COVID kicked off, the silicon chip factories, and there's not that many of them, South Korea and Taiwan, basically stopped production. And at the same time, there's a meteoric rise in people working from home and needing computing equipment of all sorts, and chips are embedded in many things. Sorry to sound a little bit preachy here, But, you know, it's a world dynamic that went off, and the industrial electronics that we use have got embedded chips in them. So they were the least priority to the chip manufacturers when they started up, because consumer electronics, automotive and markets like that have a much bigger demand. So even for people like Siemens and Rockwell, they are the poor relatives and found it difficult to get chip allocations. So that's what caused the problem. So now where's it going forward? Well, the chip demand or chip production has increased, but it can't increase dramatically because these factories cost literally tens of billions and takes 2 or 3 years to go. So what they've been doing is re-engineering their products to go for more readily available chips embedded in. So we're having to live with that. So the unreliable delivery schedules have stopped, but the lead times continue. But we've worked hard on re-engineering our products, using alternative supplies, making sure we use our planning data to ensure we have good coverage. We've placed some good stock orders for this year and into next year. So, you know, that whole supply issue, hopefully that gives people a little bit of colour. And it's an industry-wide thing. It's not just Mpac. It's key industrial electronics has been a challenge. Is there anything you want to add to that, Adam?
No, I think probably just to say that I think the progress that I saw had been completed by the time I joined the business was remarkable. You know, when I joined in November, you know, many of the things that Tony's described just now had already been completed, and actually when I think about the issues that our project managers deal with day to day that I've personally seen through November, December, Jan, Feb, March, you know, it hasn't been about significant chip shortages. You know, there's issues in every project. There's opportunities in every project. Our project managers work hard to address those challenges every day, and you know, it has not been dominated by chip shortages over in my recent experience, despite the fact that the macroeconomics haven't changed. You know, that supply issue has not gone away in the outside world. So I do think that mitigations that the team have put in place are robust. That's not to say that we won't be hit by something from left field that we don't know anything about today. And so, you know, our confidence in delivery is all about confidence in our team's ability to respond to those unexpected challenges and deal with them when they arise. So no, that's how I see it.
Thank you. I think we can accept that there is some frustration from some shareholders on here in the direction of the share price over recent periods. But perhaps one way to help return some momentum to it might be dividends. So do you have any plans to return to a dividend payment?
Well, the base answer is not in the immediate, in the short term. We review it all the time as a board. Every half year we review that, and we have a very intense conversation about it. But we still maintain that we are a growth stock. We have a strategic plan. It's been tested severely over the last couple of years with COVID and the aftermath of that, with the supply chain disruption. But our full focus is to get on with our strategic journey to grow the business and grow scale. And with scale brings a lot of other benefits in terms of covering the fixed costs. So I hope our shareholders understand that we're about growing the business. We're about getting scale, and the cash needs to stay in the business at this moment in time to keep driving that.
Thank you. Does the pension scheme contain any gearing in conjunction with the LDI exposure? And was the pension scheme a forced seller of assets?
Well, yeah, okay, I'll take that one. So yes, it does. We cover 100% or above 98% of the interest in inflation risk. Whilst only allocating, I think it's about 1/3 of the assets in the scheme to LDIs. Yeah, clearly there was volatility in the market in the second half of last year. Combined with increased collateral requirements, you know, the cost of hedging increased, and that had an impact on the surplus that's reported on an accounting basis at the full year compared to the half year. But because of that hedging, the funding level on a technical provision basis remained consistent throughout, and was in a very healthy position.
Good, thank you. I think a couple of salient questions here around the order book and you know, the outlook for the business. So consensus forecasts put it at 106 million, which someone comments looks high. Are you comfortable with it? And perhaps a little bit more broadly, can you break down the makeup of the order book a little bit more, what's been brought forward, elements of food and beverage market?
Yeah, can I pass the first half of that question to Will to talk about the order book, and then maybe he can pass to Adam to talk about what he sees, because Adam's just spent the last 2 months going around customers, so I think they can, you know, double hand that one very well. So Will, you want to talk about the order book structure first?
Well, yeah, the order book structure, the split of the 67 million, yeah, you break it down into the market sectors. There isn't a huge amount of order book left associated with the clean energy CQP line for FREYR. Circa 4 million of the order book related to that particular project. And then the remaining balance of the order book is broadly split 50-50 of the balance between food and beverage and healthcare. So it's quite an even split. Was that the second part of the question? Over to you, Adam, I think, is it?
Yeah, it's great. It's a great question to ask, and it's one of the questions that was very clearly in my mind joining the company and thinking about, you know, the business I was taking on this year. For me, it comes down to a handful of numbers and some anecdotes. So I'm going to try and get through that and answer the question for you. At January the 1st this year, we started 2023 with 65%-ish order coverage. And when I look at the company in previous years, you know, a typical January the 1st position of 50% would be a decent place to start the year. So we're going into 2023 with a good order book as a starting point. I think the other piece is that last year, services, which is a short cycle business, made up 25% of our business. So, you know, if you've got those two numbers in the back of your mind, 65% order book at the start of the year, 25% last year of our business coming from services, and we're trying to drive that faster in the future to take it up, you know, north of 25% with a target of 30% in the years ahead. We won't get all the way there in 2023, but you haven't got a lot left to close out the order intake for 2023's revenue to be secured. So, you know, that I think is the first part of it. The second part of it is around order intake this year, and the way our business works. You know, we have some fairly long cycle customers who look an awfully long way ahead in their planning for their capital programs, and our CRM system gives us some pretty good visibility of that discounted, you know, forecast of order intake. The factored order forecast for 2023 actually extends all the way out, goes 15 months into the future, so well into 2024 now, and it absolutely supports the forecast that we've put together and issued for 2023. So I think the short answer to the question, Hannah, is yes.
Confidence abounds. Fantastic. I think that has covered most of the questions that we have. Oh, like in general, how close would you say is the group to having completed the one Mpac process of integration?
Again, I'll start and then I can pass you across to Adam, because he's got a good perspective, having just come to the company. You know, the integration, I would say technically we've been integrated for some time. We work on common ERP systems, common engineering systems. We've got common CRM. We work as a global service operation. You know, the business is working as one Mpac, and that delivers benefits. There is always work to do, and the work in the next 12 months is to bring our Cleveland facility onto those common platforms as well. But then you get into a lot of other conversations about the hearts and minds and the culture of the business. Are they really working as one? And I think that's the point to turn over to Adam and say, you know, maybe share your early reflections and where your key points will be going forward.
Yeah, well, I think you said it really well, Tony. There's a bit more to do in Cleveland around our systems, and that's absolutely the focus of our teams in the sort of infrastructure part of our business this year, to get the Cleveland business closed out. The reason it's so important is the kind of operational flexibility that it brings. So, you know, we want to operate in a system where any of our engineers anywhere in the world can support any of our projects. That gives us enormous flexibility, and we're pretty close to that now. You know, if you looked at our engineering teams, for example, and did that as a percentage split, you know, the Cleveland team aside, the majority of our engineers are already in a place where that is possible. So I think we've made some tremendous progress. I would caveat though that with the cultural piece that Tony touched on. So as I joined the business in November, I had the opportunity to spend, you know, much of that month visiting each of our manufacturing sites in turn. And of course, that contrast as you go from one to the other gives you an instant sense of how aligned the cultures are. And you know, 2 of our sites have been acquired since 2019. One of them in the middle of the 2020 kind of COVID crisis as well. So I think it's probably fair to say there's more to go on cultural integration for the company for the years ahead. But in terms of the kind of fundamental systems that allow us to then work collaboratively, much of that is already in place. I'd also add the governance is absolutely rock solid. You know, the same governance processes are in place right the way across the company. So I think Tony and the team have done a very good job on that.
We have a question here. I'm asking when the board foresee a return to profits, but I would just direct that investor towards our research, where we've included all our forecasts looking forward. And you can see forward to full year 24 is detailed in there. A bit of a left field one. Have you been in touch with Mpac, who have cracked cold corrugator technology?
And when I first read that, I thought Mpac is the big exhibition that we've got going on in May in Germany. But I guess Mpac is a company. I personally haven't heard of them, but I'll pass that across to Adam. Will, have you heard of that company?
I'm writing it down as an action now.
Yeah,
thank you very much for the suggestion. We will.
Yeah.
Excellent, excellent. Well, I think that really only leaves one more question, which is perhaps a nice way for you to sign off and round up, Adam. But you know, what are your focal points as you've joined the business strategically and operationally, and your view for the future?
That is a nice summary question. Brilliant. Well, I think I'm going to reiterate something I said earlier, which is I think Tony and the team have put together a really good strategy. I think the strategy is about right. So we're not about to do a radical change of direction and go off down a completely different path. That's always a risk when, you know, a new chief exec comes in, and I know many investors are concerned about that. That is not what I see ahead for the company. I do see a need to make sure that the focus and the emphasis within that strategy is on the right areas. And for me, the 3 things that are most important right now, number 1 is our customers. You know, we're working really hard within the sales teams to make sure that we look after our existing customers and continue to broaden out the range of customers that we support, so that, you know, the reasons for that are obvious. So number 1 is customers. The number 2 piece I'm going to talk about is operational delivery. So, you know, part of the profitability challenge we saw last year was all around supply chain and the way that our operations manage delivery of projects. You know, for me, that has to be in my top 3 priorities for my leadership team and for the whole company. And then the 3rd piece is people. I think it's absolutely essential. You know, the anecdotes of labour shortages and across our customer base actually for us are very positive. Labour shortages cause a need for automation. They cause customers to want to automate. But that also places pressure on any high technology company right now, and attracting the right people, putting the right people in the right jobs, you know, that absolutely is the way for us to succeed. So for me, that's my 3rd priority. It's customers, it's the operational delivery piece, and it's people.
Well, thank you, Tony, for all your hard work over the years. Adam, we look forward to hearing from you in the months and years ahead. And thank you for everyone joining us today. Goodbye.
Thank you.
Thank you.